February 27th. That is the date COMEX does not want you thinking about, because on that day, traders must declare whether they want real silver or just paper promises. And right now, there is not enough silver in those vaults to go around. Today, I am going to show you the 3 exact moves COMEX has used every single time silver threatens to break free. The exposed playbook they are already running right now in 2026. And the one move they absolutely do not want you to make before that deadline hits. Silver is sitting around $79 an ounce today. Gold is hovering near $4,963. And what is about to happen in the next 19 days could redefine precious metals pricing for a generation. Here is why this matters to you directly. If you hold silver, if you hold gold, or if you have even thought about buying either one, the next 3 weeks are not just another news cycle. This is the moment where paper promises meet physical reality. And I am going to walk you through this step by step so you understand exactly what is coming, what COMEX will likely do about it, and how you can position yourself on the right side of this thing no matter which way it breaks. Before we get into it, smash that like button right now, drop a comment telling me how many ounces of silver and gold you are stacking, and subscribe if you want daily updates on this developing situation. I read every single comment, and the community we are building here is incredible. Let me set the stage with some numbers that will make your jaw drop. Right now, COMEX, the world's largest silver futures exchange, has approximately 103 million ounces of registered silver in their vaults. Registered means available for delivery. That is the silver they can actually hand over when someone says, "Give me my metal." Now, here is the problem. The March 2026 futures contract represents around 528 million ounces of silver exposure. That is 5 times more paper silver than physical silver available. 5 to 1. Let that sink in for a moment. It is like a bank that has $100 in the safe, but has written $500 worth of checks. That works perfectly fine as long as everybody does not show up at the same time to cash those checks. But what happens when they do? That is exactly what February 27th is about. First notice day. The day traders declare whether they want their silver delivered in physical form or whether they will roll their contracts forward. And the data coming in right now suggests this is not going to be a normal month. But here is something most channels covering this story are completely missing. And this is the part COMEX really does not want you to understand. Let me take you back to 1980. The Hunt brothers had accumulated a massive silver position. Silver was racing toward $50 an ounce. The exchanges panicked and they implemented something called Silver Rule 7. This rule did one thing. It limited trading to liquidation only. You could sell silver, you could not buy it. Imagine your brokerage calling you and saying you can sell your stocks, but buying is now prohibited. That is exactly what happened. Silver crashed from $50 to $10, an 80% decline. The Hunt brothers were destroyed. Now fast forward to 2011. Silver was ripping higher after the financial crisis, fueled by quantitative easing and a collapsing faith in banking institutions. Silver hit $49, almost matching the Hunt brothers' high. And what happened? The CME raised margin requirements 5 times in just 2 weeks. Each margin hike forced leveraged traders to sell. It created a cascade of liquidation that crashed silver by nearly 50%. Now here is 2026, and the exact same playbook is already in motion. Since December 2025, COMEX has raised silver margin requirements multiple times. In January, they shifted to percentage-based margins, setting silver at 9%. Then on January 30th, they jacked it up again to 15%. And just days ago, on February 5th, they raised it again to 18%, 3 margin increases in less than 2 months. Sound familiar? If you are seeing a pattern here, congratulations. You are paying attention. Every single time silver threatens to break out, the exchange changes the rules. 1980, rule changes crashed it. 2011, margin hikes crashed it. December 2025, margin hikes crashed it. Late January 2026, the Warsh nomination combined with another margin hike triggered the biggest single-day silver decline in decades, a nearly 40% drop from the January highs. Now pause and let me ask you something. Have you ever noticed that exchanges only raise margins when silver is going up? You never see emergency margin increases when silver is crashing. Funny coincidence, right? But here is the critical difference that makes 2026 unlike anything we have seen before, and this is the part that should have your full attention. In 1980, COMEX had plenty of silver. The vaults were full. In 2011, the vaults were full. They could change the rules because there was no underlying physical crisis. It was purely a speculative squeeze both times. In 2026, the vaults are nearly empty. Registered silver has dropped 75% since 2020. In just the first week of January 2026, 33.45 million ounces walked out of COMEX vaults in 7 days. That is 26% of registered inventory gone in a single week. The drain rate has been running at approximately 785,000 ounces per day. If that pace continues through February 27th, COMEX could be sitting on just 85 million ounces or less by first notice day. They can change the rules, yes. They can raise margins, yes. But they cannot create silver that does not exist. And it is not just COMEX. Shanghai silver inventories have plunged to their lowest levels since 2016, falling below 350 tons. London Metal Exchange inventories are at historic lows. China has classified silver as a strategic material and imposed export restrictions effective January 1st, 2026. The United States has added silver to its critical minerals list. When both superpowers are hoarding the same metal, that tells you something the paper market has not yet priced in. Now, here is where the silver lease rate becomes the most important number nobody is talking about. The lease rate is what it costs to borrow physical silver. Normally, it is less than 0.5% because silver is plentiful. Right now, it is sitting at 8%. That is a 25 times increase from normal levels. When lease rates spike like this, it means physical silver is genuinely scarce. People are willing to pay astronomical interest rates just to get their hands on it. This is the canary in the coal mine, and it is screaming. If you are still watching and finding this valuable, hit that subscribe button and turn on notifications. I am going to be covering this story daily as we approach February 27th, and you do not want to miss what happens next. So the question everyone is asking is, what will COMEX actually do when March delivery arrives? There are 3 scenarios, and each one has massive implications. Scenario 1, cash settlement. COMEX has the legal right under their exchange rules to settle contracts in cash. Instead of delivering physical metal, they hand you dollars instead of silver. This is legal, but it destroys their credibility as a price discovery mechanism. If the world's largest silver exchange admits it cannot deliver silver, confidence in paper pricing collapses overnight. Scenario 2, rule changes and forced liquidation. They raise margins again, they impose position limits, they make delivery harder. They did this in 1980, they did this in 2011, they have already done it 3 times in 2026. The goal is always the same: force leverage longs to sell, crash the price, relieve the delivery pressure. It works in the short term, but with vaults this empty, it is like putting a bandage on a broken dam. Scenario 3, paper and physical prices diverge. This is already happening. Shanghai physical silver trades at a significant premium over COMEX paper prices. If this spread widens further, it means the paper market is no longer reflecting reality. Physical silver becomes one price, paper silver becomes another, and anyone holding paper discovers that their silver contract is worth less than the metal it supposedly represents. Now here is what no one else is telling you, and this is the move COMEX does not want you to make. The February delivery data is already historic. The delivery rate right now is running at 98%. That means nearly everyone who can take delivery is taking delivery. Over 18 million ounces have been delivered just in the first week of February. These are not retail investors. These are hedge funds, institutions, and potentially industrial users who realize they can acquire physical silver through COMEX at paper prices and avoid the 6-month delivery wait from dealers. Think about that. If you are an industrial user like a solar panel manufacturer or a tech company building AI infrastructure, and your silver dealer tells you delivery will take 6 months, but you can buy a COMEX futures contract and take delivery in weeks, what would you do? That is exactly what appears to be happening. And every ounce that leaves COMEX vaults this way is an ounce that is not coming back. So what are the 3 numbers you need to watch between now and February 27th? Number 1, watch the March open interest. If it stays above 75 million ounces worth of contracts standing for delivery, COMEX has a serious problem. At current inventory levels, they simply cannot satisfy that kind of demand. Number 2, watch the registered inventory. If it drops below 80 million ounces before first notice day, the math becomes impossible. Every day, 785,000 ounces are draining. Do the multiplication. Number 3, watch the lease rate. We are at 8%. If it climbs to 10 or 12%, it means physical silver has become so scarce that the borrowing market is breaking. At that point, no amount of margin increases can fix a genuine supply crisis. Now I want to be very clear about something. I am reporting market data and news. I am not telling you to buy silver or sell silver or do anything with your money. Markets can be manipulated. Rules can be changed overnight. Silver dropped 40% in a matter of days in late January when the Warsh nomination and margin hikes hit simultaneously. If you are over-leveraged, you can get wiped out just like the Hunt brothers did, regardless of whether the fundamentals are in your favor. The supply deficit in silver has been running for 5 consecutive years now, approximately 200 million ounces per year. That is over 1 billion ounces of cumulative deficit since 2021. Industrial demand from solar panels, electric vehicles, AI infrastructure, and semiconductors is consuming over 700 million ounces annually and growing rapidly. 80% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. You cannot just flip a switch and mine more silver. New mines take years to come online. These fundamentals do not change because the exchange raised margins. The deficit does not vanish because a new Fed chairman was nominated. The empty vaults do not magically refill because traders got spooked for a week. Gold, meanwhile, is telling a similar story from a different angle. Sitting near $5,000 an ounce, gold has been on a relentless climb driven by central bank buying, de-dollarization trends, and geopolitical uncertainty. China's central bank has been steadily adding to gold reserves throughout 2025 and into 2026. When central banks are accumulating precious metals at this rate, they are telling you something about where they think the global financial system is heading. The gold to silver ratio compressed to 45:1 in January, the lowest since 2011. Historically, when this ratio compresses, it signals that silver is catching up to gold's monetary premium. Whether it continues to compress or widens again depends largely on what happens in the next 3 weeks. Here is my framework for thinking about this, and I want to stress this is how I analyze the situation, not financial advice. If the vaults keep draining at 785,000 ounces per day, the math says COMEX runs into trouble by mid-March. If the delivery rate stays above 90%, the pressure intensifies every single day. If lease rates keep climbing, it confirms that physical scarcity is real and not just speculation. On the other hand, if COMEX raises margins again to 20 or 25%, expect a violent short-term sell-off as leveraged traders get flushed. If they impose position limits or restrict delivery, expect temporary price suppression followed by an even wider gap between paper and physical prices. If they resort to cash settlement, expect chaos in the paper market and a massive premium surge in physical. The one thing that is different about 2026, and the reason I believe this time the pattern could break, is that you cannot solve a physical shortage with financial engineering. You can change the rules, you can raise margins, you can force liquidation. But at the end of the day, if industrial companies need silver to build solar panels and AI chips and electric vehicles, that demand does not disappear. Because a futures exchange changed its margin policy, the silver market is approaching a moment of truth. February 27th is the date. The vaults are draining. The lease rates are screaming. The delivery rates are historic. And COMEX has already shown you their hand by raising margins 3 times in 2 months. Now you know the playbook. Now you know what to watch. And now you know what COMEX does not want you to understand. That the paper game only works when nobody asks for the real thing. And right now, everyone is asking. Drop a comment below telling me what you think happens on February 27th. Are we about to see a historic delivery failure, or will COMEX change the rules again? I want to hear your prediction. Smash that like button if this video opened your eyes to something the mainstream media is not covering. And subscribe because I will be updating this story every single day as we approach the deadline. I will see you in the next one.